Hi everyone, welcome back to the channel. Today I'm going to take a divergence from my usual video, which I do on dividend paying stocks, because I want to talk about investing and how important it is in the modern world that we live in the current environment. Um, Investing is very important because what it does is that it increases your self confidence. Most of us have a 9 to 5 job or a business that we run on a daily basis. But in case if anything goes wrong, suppose we were to lose that job, suppose we were to get laid off, or if the business tanks and it's not that same revenue is not there, you're essentially left with very little, and the bills keep coming every month. So there has to be something to fall back on. So what it does is that it gives you self confidence, and knowing that you have some funds available to you and seeing that amount growing every month, every year, it does a lot for your stability and for your foundation. So that's why investing is very important. The question is, though, what do we invest in? Today's video is about the financial markets and the different options investors have. So let's get into it. The three types of investments are fixed income investments in the financial markets, mutual funds and ETFs, and stocks. So, a fixed income. What is a fixed income? Basically, when you invest your money in a fixed income asset, your capital is safe. You will get a specific amount of return in percentage on a yearly basis, but there's no fluctuations of your principal value. So it's usually recommended for risk averse people, people who cannot handle the volatility of the stock market and they want to see their principal safe. Those are the people who should be investing in fixed income assets. Also, those people who are close to the retirement age, where they want that safety net, they want their principal to be safe, even though the return might be lower compared to the stock market. Those near retirees can also invest in fixed income assets. So, examples include government certificates, guaranteed income certificates, or GICs as they're called in Canada, or other fixed treasuries in the US that ensure that your capital amount is safe. Secondly, we have the mutual funds or the ETFs, also called exchange traded foreign funds. Short form is ETF. What you're doing with the mutual fund is that you are buying a basket of stocks instead of one specific stock. So think of it as buying specific shares of different stock companies all in one go. That's your mutual fund. The advantages of a mutual fund is that you are mitigating the risk by diversifying. So you're buying many different companies instead of buying one particular company. Suppose that one company that you were to invest in goes down, goes bankrupt, or its stock price goes down for a specific reason, you're essentially better off because you've only invested just a small amount when you're buying a mutual fund. The other thing about mutual funds is that there are different types of mutual funds. There are sector-specific funds, and there's also index funds. Sector-specific funds can be all the companies in a specific sector, such as the tech sector or the utilities. These are sectors with specific companies or consumer staples, such as Walmart or Target, which would go into the consumer staple sector. So you're instead of buying the entire stock market, which is what index funds are, you're buying a specific sector to invest in. The one thing to look after with investing in mutual funds is the MER, known as the management expense ratio. Usually, that can go between 2 to 3%, which doesn't seem like a lot, but over a long period of time and in a high, when investing thousands of dollars, that 2 to 3% can turn out to be a huge number. So that's the big disadvantage with mutual funds is that the MER, the management expense ratio, that is quite high, and that money is going to the fund manager. In index funds, the advantage is that this MER percentage is on the lower side. It's actually about 0.5 to 0.6%, which is much better than the 2 to 3% that sector-specific mutual funds charge. Lastly, we talk about stocks, investing in specific stocks. To purchase stocks, I would recommend doing your due diligence, making sure that you've thoroughly researched the fundamentals of the company before putting your hard earned money into the stock market. What you want to look at is you want to look at the financial statements, which are the income statement and the balance sheet, to make sure that the overall financial health of the company is stable. A lot of people would just go by what they hear from their friends or colleagues and invest in particular companies after that discussion that they've had without doing the proper research. I wouldn't advise that because, after all, it is your hard-earned money, and you want to make sure that you get a return on investment that is healthy, but also that your capital stays as is. When investing in stocks, there are growth stocks and there are value stocks. The difference essentially is that the value stocks are not as volatile and they issue a dividend to the shareholders, whereas growth stocks are newer companies on the stock market and their share price is very volatile. It can go up or down, and they don't issue a dividend. So that's a big difference between the growth and the value stocks. So this was basically a general video, a very basic video to new investors who are thinking about investments. This topic was about the financial markets. There are other things you can invest in, such as real estate or crypto. That may be a topic for another video down the road. But today's topic was the introduction to financial market and investments in the financial markets. Hopefully, we'll see you next time with another video. Thank you.